Hello everyone, my name is Ryan and I'm joined by my colleagues Hayden and Chris to present our findings for this market view presentation. So we've analysed the relationships between the AUD to the USD and the AUD to the JPY, and I'll be starting us off with the technical analysis for the AUD to the USD. So to start us off, the previous 5 years, the Australian and US dollar have had a fairly volatile relationship, with 2013 being the peak of the Australian mining boom. One Australian dollar bought over $1 in United States currency. The peak of this was the 11th of April 2013, where the AUD to the USD reached $1.05. Since then, however, with the fall of the mining boom and a change in both countries' economic conditions, the AUD to the USD has not been higher than this point in the last 5 years. So in this time frame, the lowest the AUD dropped was to 68 cents, which was in January 2016, marking one of the rare times in recent history where the Australian dollar has dropped below 70 cents compared to the US dollar. So in 2017, the AUD has had a gradual recovery thus far and sits at its highest point since 2015. So moving on to the 1 year analysis. So the end of 2016 marked a moderately weak Australian dollar, with the AUD hitting 71 cents and looked likely to go under 70 cents for the first time since the beginning of 2015. However, the sharp recovery in 2017 previously mentioned caused the dollar to increase to a high of 81 cents on this September 8, 2017, and although it has dipped below 80 cents in that time, this trend only seems temporary, at least for the time being. So now on to Hayden, who will provide the fundamental analysis between the Australian and the US dollar.
Hello, I'm Hayden, and now we're reporting on the fundamental analysis for AUD-USD. From May 2017, the AUD has continued to appreciate against the USD, and is currently the highest it has been since January 2015. The team believes it will sustain this trend in the coming months for the following reasons: a higher relative interest rate, a lower relative inflation rate, and a lower relative growth rate. Interest rates have a strong correlation with exchange rates. When interest rates in a country are relatively higher, this attracts foreign capital, as lenders will have the incentive to invest their funds at a higher rate. This is due to the higher return they receive compared to the return elsewhere. The Reserve Bank of Australia has recently announced on the 5th of September that interest rates will remain unchanged at 1.5%, whilst the Federal Reserve announced on the 15th of June that the target interest rate would increase to 1 to 1.25%. The team believes that the RBA cannot change their policy stance due to extremely high household debt and the possibility of a housing bubble if interest rates were to be cut, whilst needing to maintain sustainable economic growth and inflationary levels. The Federal Reserve's interest rate will go unchanged until they meet in December on the 13th, where, according to David Payne, an economist from Kiplinger, the rate is expected to rise by 0.25 percentage point in order to stay in front of any inflation that rising wages may generate. The relative inflation rate for two countries is crucial in determining the exchange rate between two currencies. A lower relative inflation rate tends to increase a currency's value due to a rise in purchasing power when compared to other currencies. The Reserve Bank of Australia has a target rate of 2 to 3%, whilst the Federal Reserve aims to keep its inflation at 2%. Recently announced by the RBA and the Federal Reserve, the current inflation rate for Australia and the United States are 1.9% and 1.7% respectively. Although the United States inflation rate is currently lower than Australia's, the team believes that this won't sustain in the next few months. This is due to the Phillips curve trade-off between inflation and unemployment. This diagram displays that when the unemployment rate is low, it is expected that the inflation level will rise and vice versa. Australia's current unemployment rate is at 5.6%, whilst the US have an unemployment rate of 4.4%, meaning the US are expected to have a higher inflation rate. The natural disasters in the USA in both Texas and Florida may also push inflation higher due to the costs of rebuilding. However, the RBA have stated that as the Australian economy gradually strengthens, the inflation rate should rise. The RBA also believed that higher prices for electricity and tobacco are also favourable to an increase in the CPI. Inflation, although increased competition from new entrants in the retail industry may cause inflation to decrease. A higher relative growth rate will lead to a depreciation of the domestic currency. This is due to imports growing faster than exports, resulting in a larger increase in the demand for foreign exchange than the supply of foreign exchange. According to the Federal Reserve, the growth rate for the US as at July 2017 was 3%, whilst the RBA reported that growth was 0.8% for Australia in the same period. In the next few months, the team believes that Australia's growth rates will remain lower than US's rates, due to Australia having stagnant wage growth and a slowing housing market. The team also believes that other factors including commodity prices, uncertainty with North Korea, as well as Donald Trump's promises remaining skeptical, also have an impact on the exchange rate. Overall, the team expects that the AUD will appreciate against the USD in the coming months, for the mentioned reasons. Ryan will now discuss the technical analysis for AUD JPY.
So moving on to the technical analysis between the AUD to the JPY. So to start us off with the 5-year analysis. So the AUD of the JPY has followed a relatively similar trajectory as that of the AUD of the USD, and the Australian dollar was fairly strong against the yen in 2013 due to instances such as the mining boom and commodity prices, and slowly decreased to its lowest point in 2015-16 and has since made a gradual recovery. So the highest point for the AUD against the Japanese yen in this period was in April 2013, where $1 Australian dollar bought 105.2 Japanese yen. By June 2013, however, the AUD decreased back down to below 90. From this point until mid-2015, the Australian dollar remained relatively steady, and 2016 brought the dollar to its lowest point in the previous 5 years to below 80. So onto the 1-year analysis. So 2017 has marked a gradual increase in the AUD to JPY. The beginning of the year marked a relatively high rate for the Australian dollar, with the AUD buying 88 Japanese yen on the 15th of February. That was the highest rate for that fiscal quarter, as the AUD gradually decreased from that point to its yearly low of 81 on the 19th of April this year. During the middle quarter, the dollar remained relatively steady, buying around 86 yen between the months of June and August, and has since climbed to its peak position of 89.65 in late September. So now on to Chris, who will provide the fundamental analysis for the AUD to the JPY.
Hi, I'm Chris, and I'll be giving the fundamental analysis for the AUD to the JPY exchange rate. First factor we're looking at is relative interest rates. According to the Reserve Bank of Australia in 2017, Australia's current cash rate is 1.5%. The RBA plans to keep the current cash rate at this level as they are happy with other macroeconomic variables. According to the Bank of Japan in 2017, the current cash rate is minus 0.1%. Harding in 2017 states that the Bank of Japan will continue with its current monetary policy and have not planned for any interest rate hikes. Due to Australia's interest rate being higher than Japan's, this leads to higher rates of capital inflows into Australia. This occurs as foreign investment into Australia is more appealing as it provides higher returns in comparison to Japan. Therefore, demand for the Australian dollar increases as foreign investors seek to purchase government securities. In addition, Australian investors realise higher returns associated with domestic investing, so they reduce the supply of the AUD by domestic internally. The overall effect is a high exchange rate as the AUD appreciates against the Japanese yen. The next factor is relative inflation rates. According to the Reserve Bank of Australia in 2017, the current inflation rate in Australia is 1.9%. The Reserve Bank of Australia contend with the current rate as it meets their inflation target of 2 to 3%. According to the Bank of Japan in 2017, the current inflation rate in Japan is 0.4%. The Bank of Japan is currently aiming for an inflation rate of 2%. Due to the lower inflation rate in Japan, Australia experiences a higher demand for Japanese goods. This occurs as Australian goods and services have become more costly as inflation is higher and means that Japanese goods are relatively more inexpensive. This increases the supply of the AUD as funds travel abroad, which shifts the supply curve to the right. In addition, the demand for Australian goods falls as they become more costly. This reduces the demand of exports as well as the AUD. The effect of this is that the demand curve shifts to the left. The overall effect is a low exchange rate as the JPY appreciates against the AUD. The next factor is commodity prices. Commodity prices are an important aspect of exchange rate as shifts in price levels can cause one currency to appreciate against another. This occurs as high commodity prices raise the value of exports or imports for a given country. According to the Observatory of Economic Complexity, Japan and Australia are major trading partners. The Australian government states that Australia's main exports are commodities, with iron and coal being the topmost export. Furthermore, Asia for Educators and the Department of Foreign Affairs and Trade states that Japan has few natural resources, so they must import these from Australia, particularly iron and coal. The Commodity Price Index of Australia shows a steep decline in commodity prices over the past years. Although these have increased over the past few years, this is related to other supply and demand variables. According to Hayden in 2017, the supply side has been affected due to flood-induced coal mines closures in China. This has reduced the supply of coal in the global context and raised the price. This is good for the AUD as it means that foreign countries will need more AUD to buy exports from Australia. This, in 2016, states that demand for coal and iron has also increased due to Chinese government's increased fiscal stimulus. This is also good as more countries are requiring the AUD to buy Australia's exports. However, according to Clark in 2017 and the St. George Bank, the rally of iron coal prices are short-lived as this speculative buying subsides and low-cost supply increases. This will have a negative effect of the AUD into comparison to the JPY, as less Australian dollars will be needed by Japan to buy Australia's raw materials. In conclusion, as interest rates and inflation rates remain the same over the coming months, it is unlikely that these factors will affect the exchange rate. This team believes commodity prices are the underlying factor to the AUD-JPY exchange rate. Therefore, as commodity prices begin to drop and continue to do so, we believe that the AUD will depreciate against the Japanese yen. These are our references. Thank you for watching our market view presentation.